Bruce Flatt is the CEO of Brookfield, which is now the largest position in my own portfolio by a wide margin. And recently, he did an interview with Forbes talking about what he thinks about the overall market and the economy right now. He also discusses what he thinks about investing in China and a lot of other macro things going on. Bruce is also known as the Canadian Warren Buffett, so every time he does an interview, I think that it is incredibly insightful to listen to, and he gives us a lot of key investing tips in this video. So I think that this is going to be a very valuable video for all investors, and I want to go through the certain clips of this video and then also just break them down more. So with that being said, let's dive into it.
Okay, Bruce, you have almost $1 trillion, is that right, in assets? So you can tell us what you think's overhyped.
You know, clearly the word of the day is AI, but I would say maybe
you think
even
AI is overhyped?
Everything gets overhyped when everyone's into it. But I would say maybe more importantly, I think it's negativity. When we hit bottoms of the markets and we're trailing along, everyone quits investing. And they worry about politics and recession and interest rates and you name it, there's 15 other things. And I would just say that's when people should be investing. So I'd say negativity is overblown. And
we Canadians are positive people,
you
right?
got it. You got
Very
it.
Much
Stay positive and stay invested.
So. Baroness.
Okay, so this is a really quick first clip, but Bruce basically started off by saying that he thinks that artificial intelligence is overhyped right now. Then the speaker kind of rebutted him a little bit and was like, you think that AI is overhyped right now? Like almost questioning him. And then he rebutted back saying, yeah, whenever everyone is concentrated on one thing or one sector or one stock, it tends to get quite overhyped and kind of overvalued. So let's now go and take a look at Nvidia stock, which is now up another 5% on the day today and trading at just under $430 a share. This stock has ran nearly 300% just in the past 6 months alone with all of the AI hype that is currently going on. If we also go and take a look at Nvidia's price to free cash flow, it is now sitting at just under 200. So this stock is trading at 200 times free cash flow. So yeah, I mean, even if AI does become this massive thing, which honestly it probably will, Nvidia is already pricing in so much future growth. I did a DCF here on my channel recently, and I found that Nvidia needs to grow its free cash flow by like 50% annually over the next 5 years, which would basically mean that it has to like 5x its free cash flow over the next 5 years just to justify the price today and still trade at a 60 price to free cash flow. So artificial intelligence stocks are, I agree, kind of overhyped right now, and I think that they are getting quite freaking expensive. Now, another very interesting thing that Bruce said was that when the markets are going down, people tend to stop investing and they actually leave the markets. They start worrying about a bunch of different things, like 15 different things, interest rates, inflation, a global recession coming up. And this tends to happen when the markets are going down and negativity is really starting to get severe. However, he says that this is the time you actually want to be investing and buying stocks. And for example, let's go and take a quick look at Google's historical price to free cash flow. Because right here, we can see that in November of 2022, just about 6 to 7 months ago, Google was trading for a price to free cash flow of only 17. If we go and take a look at the stock market crash of 2020, we can see that Google was trading for a price to free cash flow of 23.4. And if we go all the way back here to 2012, we can see that it was trading for a price to free cash flow of 14.8. So Google was basically trading for the lowest priced free cash flow that it's seen over the past decade and a lower price ratio than it was trading for during the stock market crash of 2020. That is how scared and how much negativity was going on in the overall stock market back at the end of 2022. This is when Google was trading for about $80 a share. It's now ran something like 40 to 50% from those lows, but this is the time right here where you actually want to be buying stocks. And on my channel, I made a video when Google was trading for this price ratio right here, saying that I thought it was a tremendous opportunity to buy one of the best businesses in the world at the lowest price it was trading for, or price ratio that it was trading for over the past decade. So instead of chasing the hype on artificial intelligence stocks like this, the time you actually want to be investing is when there is negativity, and that negativity is pushing down stock prices to points where it becomes an incredibly attractive time to start buying them. Now let's move on to the next clip right here, which starts around 3 minutes.
What's out there? Okay.
So I think underappreciated, the difference in my answer and Debisa's answer is the fact that My answers are always long-term in thinking, and I'd say the most underappreciated thing in the world, most of the time, is the long-term compounding of wealth. And I'm not, when I say be positive and keep invested, it's not for the next 6 months, 2 years, 3 years. It's the next 20 years. The markets will compound, and great wealth is created by compounding. And so stay invested, buy great things with great people and great companies. And
no money
and you
under
can make a lot of money.
mattresses, bad strategy.
Okay, so right there, Bruce Flatt is saying that one of the most underappreciated things in the entire world is the long-term compounding of wealth. And when he says long-term, he's not talking about the next 6 months to 2 years. He's talking about literally the next 20 years. And all of his answers and all of his thinking is always focused on the extremely long term, 20 years plus. Bruce Flatt has been the CEO of Brookfield for 25 years now, I believe. And over that time, Brookfield has compounded at around 20% annually because he likes to think long term and make decisions today based on what's going to happen over the next 20 years and not based on what is going to happen over the next 6 months. Now, what is also interesting is that when you start to think long-term like this, then you start to realize that a lot of what the market is worrying about today simply becomes irrelevant. This also allows you to take advantage of the short-term worries that will not affect you in the next 10 or 20 years. And this is exactly what Bruce is urging us to do, is stay invested and not worry about all of the things that are going on today, but instead think over the next 20 years and really ask ourselves, is everything going on today truly going to affect us and the global economy 20 years in the future? Today, just even today, the market is so focused on what Jerome Powell is saying about interest rates over the remainder of 2023. But when we zoom out to 2045, do we think that what Jerome Powell is saying about interest rates today, raising 25 basis points, is really going to matter 20 years in the future? Probably not. So if the market wants to worry about these things and then sell off stocks, let's say that the stock market crashes on a 25 basis point increase, and we're thinking 20 years out into the future, then that would look like a massive opportunity for us to continue buying fundamentally sound businesses while everyone else is worrying about the next 6 months. So that's basically what Bruce is saying here. Now, the next clip is all the way out at 9 minutes and 3 seconds, and let's just go and play that now.
Look, I would just say I buy everything Dambisa said, except...
We don't want that.
No, I would say I buy all that stuff, except what I would say
okay, good. Yes,
is
I'm
that
sorry.
when everyone is as negative as that, the market is at the bottom and we're turning. And that is always what occurs. And the fact is, what Mary just said is
there's... That makes you a reverse indicator, I
the
believe.
multiples, I don't think are attractive when you say reversing.
There is always stuff happening. And
that's
why
true.
private assets are really important. Remember, what's happening in the world is credit, private. Private equity, private. Infrastructure, private. Everything is going to private. Why? It's not the extra return you get from private. Yeah, that's sometimes important. But what it is you lose the distraction. You get rid of the distraction of the public market. The value of a company is this. The price goes up and down along the way.
And you don't have to pay a premium for it to be ready and available for you, 8 hours a day.
Every hour. And in fact, you don't want it readily available every hour because it distracts you. Even I'm the longest term investor you can find, except I get distracted.
Warren Buffett.
I get
That's what I've
distracted
heard.
by the markets.
Do you?
And they're terribly distracting, and that's a bad thing for long-term returns for investors. And that's why private investments are extremely important for institutional clients today, and increasingly they're going to be for wealth. And Mary can talk about that more than I can. But increasingly those products are all shifting into private individuals because of I'd argue most of it's because of the distractions. You don't have to worry about it, David.
So really interesting. I don't know if you guys heard that, but the speaker chimed in there when Bruce said that he's one of the longest term investors you'll ever find. She was like, "You're the Canadian Warren Buffett, I've heard." So yeah, he is referred to as the Canadian Warren Buffett. But Bruce is making an interesting point here. One thing that he said is that value tends to go like this of a business, but the price of that business goes like this, and the price is a lot more volatile. And the price in the markets, the public markets especially, is incredibly distracting. It even distracts him. So what he wants to do is focus on his underlying business and acquiring businesses at a good value. But the markets are so volatile, especially recently, and that causes us a lot of distractions from our long-term investing, and it can actually hamper our long-term investing. And I actually have a really good example, which I believe is exactly what Bruce Flatt is talking about. So we're going to go and take a look at Equitable Bank's earnings or net income over the past like 20 years. And here we can see that the earnings for the most part have been consistently going up. And this is typically what investors value a business off of, is how much earnings or cash flow it can produce for its investors. So again, you can see that this is a pretty dang stable line going up and to the right. Now, if we add in Equitable Bank's stock price to this chart, we can see that the stock price is much, much more volatile. And if we zoom in here to about 2013, this area is really interesting. So before the Great Recession, before the banking crisis, Equitable Bank's stock price was $17 a share, and it was producing earnings of $29.5 million. Now, over about the next year and a half, Equitable Bank's stock price fell all the way down to $4.65, which is a decline of over 70%. However, the net income grew by about 25%, all the way up to $38 million. So you can see that the stock price fell 70% while the earnings continued to grow, which overall means that the intrinsic value of the business actually continued to grow while the stock price fell 70%. Now, Bruce does say that this is a massive distraction in the markets, and I would agree. It does distract us from long-term investing when we get caught up in the day-to-day price action of businesses. However, I also think that this volatility is what creates opportunity for investors. Because think about it. If you were an investor here in 2008 and you were focusing on the underlying fundamentals and the earnings growth of Equitable Bank, then you would have been able to buy the exact same business producing even more net income at a 70% discount to a price that it was trading at just in 2007. So for investors who focus instead on the fundamentals of the business and not on what the price is doing, I actually think that volatility can be your friend and present you with opportunities in the stock market. Now, the next clip here is at 15 minutes and 20 seconds, so let's go and take a listen to Bruce again.
We invested in China now. In essence, there's lots of opportunity. And again, Bruce Nambisa, I don't know if you want to weigh in.
Yeah, so look, we're in 30 countries. China, we're a significant investor. And I would just say the difference for us versus many is we can choose whose money we take there. So some of our investors are very interested in China. Middle Eastern investors very interested in China. Asian investors very interested in China, and obviously Chinese investors very interested in China. There are others that are not interested in investing in China, but that doesn't.
Would that
for
be
us,
American investors?
That would be a fair assessment.
Okay. Just asking.
But so I would just say for us it's a little different. We have a great business there. It's always been phenomenal. We've made a lot of money over a long period of time. And we're going to keep investing there. It's just whose money we bring there is the difference today.
Okay.
And in past, that's changed over the past 5 years.
Okay, so the speaker basically asked Bruce here, what do you think about investing in China today? And kind of what are you seeing over there? Bruce responds very clearly and says, we have always been investing in China. We are planning on continuing to invest in China. And what Brookfield does is they raise tens of billions. Well, actually, last year they raised $100 billion from their institutional investors. And what they do is they take in that money and then invest it around the globe. So what he is saying is that some of their clients are very happy investing their money and Brookfield's money over in China. People over in the Middle East, people in India, people in China, they all want their money, or they're happy to have their money invested back into China. So he's saying, yeah, we can raise money from these investors and they're happy for us to be deploying that cash over there. However, when it comes to American investors, they do not want their money invested in China right now. That's basically what he was hinting at. Overall, it sounds like he is still bullish on the long-term success of China, and Brookfield has always had a business in China. They've been there for something like 30 years, he said. And he said that they're just going to continue investing in that economy. I also think that there's a lot of fear and uncertainty surrounding China stocks right now, but I think that this is also leading to some very incredible prices on these stocks. For example, if we take a look at the price to free cash flow of Alibaba, we can see that it is currently trading for about 9.8, which is the lowest that the stock has traded for over the past 7 years. I mean, back here in 2019, it was trading for a price to free cash flow of 26, and it was on par with a business like Google, really. However, now with all of the fear surrounding China, it's down all the way to 9.8. And I think that this is still a very fundamentally sound business. It has like a third of its market cap in cash on the balance sheet right now. And it's still producing a tremendous amount of free cash flow for its investors and now buying back shares. So I think that the underlying fundamentals of this business are fine. There's just a lot of fear and uncertainty around these Chinese stocks and the China economy right now, which is causing a lot of investors to avoid it. But at the same time, this is also causing those stocks to become quite cheap. And Bruce, again, is very clearly saying that he is still bullish on China for the long term, and Brookfield is going to continue investing over in China. Now, the last clip that we're going to discuss starts right here at 22 minutes and 40 seconds. So let's play that.
I'm a fundamental bull.
Good.
Make the market.
After 35 years of doing this, I found it to be healthy, to be that way. But what's really, really important is do not ever get yourself in a position where if the markets don't go with you, you ever get called out on your position. Because you can make a lot of money in the long term if you compound wealth, but if you get called out in the middle, you're done. And so you need to be really fiscally prudent in what you do. But on top of that, I think the situation we're in, yes, all of the issues that are talked about are here, but the AI and the things that are going on in the world today with technology are raising populations around the world out of poverty, and every day we get more educated people, and that means wealth is being dispersed to them every day. And that's going to be better and better, and it's good for everyone.
So Bruce starts off this clip by basically saying, don't use margin and don't use leverage. He's saying that compounding over the long term is incredible, but if you're using margin and you get margin called and it completely wipes you out halfway through your long-term compounding, then you're back at zero and you're completely out of the game. So he's saying that investors should remain fiscally prudent and not rely on debt or margins to increase your returns. Just compound your wealth slowly over the long term and don't try to speed it up by taking on a lot of fiscal risk, is basically what he was saying. Then he also says that over the long term, he believes that there's going to be a tremendous amount of opportunity and wealth created in the global economy because technology and AI are pushing a lot of people out of poverty around the globe. This is a screenshot right here that I have shared many times on my channel. I've actually gotten comments from people saying that I share this screenshot too much, but this is just what the data suggests right now. These charts right here show us where the growth to the middle class globally is going to come from over the next 7 years now. And we can see that India is going to see a massive boom to its middle class, and so is China. And over on the right-hand bar chart, we can see that the Asia-Pacific region is going to bring 1.1 billion people out of poverty and into the middle class over the next 7 years. This is going to cause a massive boom in the world economy, with so many new people entering the middle class and having more disposable income and overall entering capitalism globally. So I think that Bruce is basically saying that this is a real trend and this is a real tailwind behind the global economy, and it's real and it is going to continue growing for the next 10, 20, 30 plus years. So stay focused on the extremely long term is basically what he is saying. So that was the last clip from Bruce Flatt. I think that he is an incredible investor. Again, he is known as the Canadian Warren Buffett. He is the CEO of Brookfield. And honestly, he is one of the reasons why I am so comfortable and confident having Brookfield be the largest position in my portfolio. One, I think that it is very cheap right now. Two, the historical returns of that business have been incredible. Three, I think that they are going to be able to continue compounding at those returns for the foreseeable future. I think that this business has a really long tailwind in front of it. And four, Bruce Flatt is an incredible capital allocator. He's an incredible value investor, and he is the CEO of Brookfield. So I think that, you know, as long as he's at the helm, he's still a relatively young guy. He's got a lot of time left. And I think that he's going to continue to be able to compound Brookfield and grow the overall business over the long term and generate some substantial returns for its investors. So that's just some of the reasons why I am a fan of Bruce. That's some of the reasons why I am invested in Brookfield. It's my largest position. And I hope you guys enjoyed this video. If you did and you found it helpful and useful towards your own investing, then please remember to leave a like on it. It really helps out the channel and I really appreciate it. And if you're new here and you want to see more stock market related content like this that is focused on the fundamentals and no hype, then please consider subscribing to the channel as well. But that's going to wrap up the video for me today, everyone. Thank you again so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.